to fail addresses the unexpected collapse that happened in the banking sector in the United States and that spreaded the financial industry not only in the United States but in the globe. It highlights the failure of the fourth largest investment bank that had over 25,000 employees across the world, which is Lehman Brothers, and the Federal Reserve intervention in order to help this company go back to its normal life. The United States economy is controlled by three major categories: banks, households, and housing. Starting in 2000, United States of America knew a significant growth in its economy. It was in the peak of stability, very low inflation rate, and very low unemployment rate. All the stock market indexes increased sharply during this period. The S&P grew by 50% per year, and stocks, homes, and securities prices increased rapidly. In other words, banks were creating too much money and in a very rapid way. And as we know, the more loans are given by banks, the newer money is created. This makes the amount of money and debt in the economy doubled. About 31% of money that was created went to housing and residential properties. This boosted the houses' prices, and the Federal Reserve allowed the housing prices to reach unsustainable levels. 20% was consecrated to commercial real estate, 30% went to the financial sector, 8% was given to businesses operating in other sectors, and the remaining 8% went for credit card and domestic loans. Eventually, credit expanded and started to be given to people that are not qualified and who have weaker credit profiles. At this point, debts became unpayable and banks found themselves exposed to the danger of bankruptcy. This is what we call subprime lending, and it is one of the main causes of the 2007-2009 financial crisis. Another cause that plays a crucial role in the emergence of this big crisis is the securitization. At that time, the market of mortgages was commanded by savings, loans, and commercial banks. Usually, these entities securitize their mortgages through government-sponsored entities, GSEs, like Fannie Mae or Freddie Mac. But these entities are allowed to securitize only the graded mortgages. However, lenders didn't want to make riskier loans, so lenders didn't want to securitize the mortgages through GSEs, but instead, they chose investment banks. Wall Street banks started issuing mortgages from underwriters and then transformed them to mortgage-backed securities. In order to reduce risk, they started adding mortgages from different places and are not rated. But even though they started rating them as favorable, with the expectation that the housing will always go up, and sadly, this was not the case. Another cause of the financial crisis was the business model followed by the investment banks. Actually, both commercial and investment banks were responsible for the Great Depression of 2007-2009 because they both packaged, sold, and bought MBS. Usually, these forms of securities transaction are not mentioned in the balance sheet, and this didn't give accurate account of leverage. MBS were mainly financed using wholesale funding, which are deposits from outside the banks, traditional customers like governmental institutions using commercial papers and repurchases. Investment banks don't deal with customers, and that's why they don't have retail funding or the Federal Deposit Insurance Corporation that the commercial banks do have. In fact, investment banks used to have very weak business model, and this made them very vulnerable to shocks. From all what was stated earlier, this didn't have an impact on the economy until 2006, when warning signs started to appear. First of all, the real estate value started to fall, and one of the 5 big investment banks in Wall Street was in difficulty. The investors and lenders were asking for their money. The markets became non-liquid and the crisis warning exceeded the country and starts affecting other banks outside the country. Now let's have an idea about the Fed, its roles and strategies adopted during the crisis. The Fed is the central bank of the United States of America. It was founded to provide the country with a safe, flexible, and stable monetary and financial system. Its roles can be summarized in the following: maximizing employment, stabilizing prices, and lenders of last resort. Failures of businesses usually lead to consequences related to the employment instability and fluctuations of prices and rates. This gives the Fed the right to intervene in order to find solutions before a crisis is born. Normally, investment banks were not under the protection of the Fed. They operate freely and also they have to assume the responsibility of bankruptcy by their own. However, after the Great Depression, a new act was added allowing the Fed to make emergency loans to any individual, partnership, or corporation under unusual circumstances. The question that comes to our mind: would the Fed help the investment banks to go out from the crisis of 2007-2009? And what was its response? Bear Stearns was the smallest investment bank of the 5 Wall Street banks. The business used to operate on different areas. Among them, there was capital markets, investment banking, global clearing services, and wealth management. The company went bankrupt during the 2008 financial crisis and it was sold to JP Morgan. But we need to know how it went bankrupt and how the Fed intervened in order to make it stay alive. The problem of Bear Stearns is the fact that securitization and trading business were large parts of its operations, and they were the largest components of the firm's fixed income. However, in 2007, Bear reported a quarterly loss. At that time, it was the first one to start facing failures. As a consequence, rating agencies started giving them warnings. Their stock price went down and confidence was reduced. Bear opened a business of $18 billion, but its liquidity pool was down to $2 billion in 2013. Bankruptcy was the last source of the bank. The firm was insolvent and there was no liquidity. The Fed announced on Friday, the 14th of March, at 5 p.m. that they are going to lend JP Morgan Chase $20.9 billion, which in turn will lend to Bear so it could meet its obligation. The amount given was not sufficient for Bear to survive, and in the same day, the stock price went down by 47, and they knew that the company won't open its doors in the coming Monday. During the weekend, the Fed resolved this crisis and thought that the only solution is to sell the firm to a very strong business that can absorb its debts and make it survive. Bear was acquired by JP Morgan, but this latest imposed many obligations and conditions before the acquisition. First of all, the Fed forced Bear to sell 30 billion of assets to the new company, but JP Morgan didn't want them on its balance sheet. The Fed accepted, and the investment bank was sold to JP Morgan at a price of $2 per share, later raised to $10 per share. The decision of rescuing Bear came down because the government thought that this bankruptcy will have a huge impact on the economy of the country. In addition to this, Bear were having many connections with other financial institutions in the country, and its failure would impact others as well. However, by taking this decision, the Fed didn't take into account the moral hazard issues. Fannie Mae and Freddie Mac are two federally backed home mortgage companies created in 1938 and 1971, respectively, by the United States Congress. Their objective was to increase the flow of funds into housing and to create a liquid secondary market for the trading of mortgage loans. They issued underwritten residential mortgages from loan associations, approved lenders, commercial banks, then they packed them in the form of MBS and finally sold them to investors. The two companies were operating as public companies. That's why they were under the protection of the federal government and they were taking advantage from borrowing at extremely low cost, treasury rates. Concerning the problem, the companies, both of them were owning more than $5 trillion in residential mortgages and MBS in the world. Half of them were in the United States. Most of their activities were financed using debt, and this led them to be the largest companies that has a huge amount of debt in 2007. Once the housing market began its epic and historic free fall in 2008, Fannie Mae and Freddie Mac faced an imminent collapse. Their losses mounted to $5.5 billion, and their stock price dropped quickly from $7 in September 2007 to $0.66 a year later. The debate raged over whether to save the institutions that owned or guaranteed about 40% of all home loans and helped so many average Americans buy residences. After the bailout, the Federal Housing Finance Agency placed Fannie Mae and Freddie Mac into government conservatorship. That is, it took them over, which it had authority to do as their regulator. The bailout gave Fannie and Freddie the financial liquidity they needed to survive, but also required them to pay the Treasury a 10% dividend as part of the deal.
The advent of Lehman Brothers. In 2007, Fortune magazine ranked Lehman Brothers Investment Bank #1 on its list of most admired securities firm. But just 1 year later, on September 15, 2008, the financial world was shocked when Lehman, with 600 billion assets, filed for bankruptcy, causing chaos in financial markets. Let's discover why. Lehman Brothers was founded in 1950 and operates within the investment service industry. The bank is headquartered in New York and had three main business sectors: capital markets, investment banking, and management. In 2007, what are the reasons behind the collapse? High leverage, losses, subprime mortgage crisis traced the path of bankruptcy. So Lehman Brothers was over leveraged. In 2006, Lehman had invested heavily in high-risk real estate and subprime mortgages. When this market turned south, Lehman couldn't raise enough cash to stay in short-term obligations. So the loss was resulting from having held on a large position in subprime mortgages and real estate. So consequently, the reported losses of 3.9 billion implied a sale of a majority of stakes in the investment management business assets. In detail, the economy was doing good. The Fed decided to raise interest rates more. So the mortgage loan increased too, and people started investing in real estate, causing a new housing bubble. Mortgage loans couldn't be paid because people took loans and couldn't afford to pay them back. The bank couldn't be able to cover the debts, and the gambling on banks started. Lehman, in this time, incurred a loss of 2.8 billion and filed for bankruptcy on September 15, 2008. In balance sheet terms, they showed that they owned more than they own. That's never good. And Lehman Brothers went bankrupt. In 2008, it had 639 billion in assets, technically more than enough to cover its 630 billion in debts. But the assets couldn't be sold easily in the short run. For the bailout solutions, The first option to rescue Lehman was bank nationalization, which is frequently a mean of enhancing economic power and wealth. But in the United States, this practice remains very rare. The Swedes had a relative simple task in doing so. They never had to deal with institution of the size and the complexity of the banking system. Also, this process went amazingly well in Sweden crisis because mainly it was remarkably free of political interference. The second option is to introduce a private sector to buy or to merge Lehman with. Bank of America and British bank Barclays were the candidates for using this rescue option. But the deal fell through because it was a timely and risky move for both banks, and Lehman had only 48 hours to escape the fate. The third and the last solution was to provide a government financial assistance. In this case, the Fed will buy shares without having the full control and ownership of the bank. But this solution, if it was approved, was to be used to save the other banks in deficit also, and only a thousand of eight and only 100 of 8,300 banks were in a good financial health. So on the verge of declaring bankruptcy, the night before Lehman urgently begged the Fed for support and assistance. Senior decision makers firmly rejected the requests and responded no. Why has the Fed said no? Lehman bankruptcy was shocking, in part because it was unique. Other financial institutions, such as Bear Stearns, also experienced a crisis in 2008, but surely would have failed if not for emergency loans from the US Federal Reserve. In the decision to let Lehman fall, it is because of the three reasons. Lehman was inferior to Bear Stearns in terms of financial stability. Two, the whole economy is more damaged comparing to the time of when Bear Stearns bailout. The Fed could not provide a viable way to lend such a huge amount to Lehman during these financial hits. Four, there was no possible additional bailouts for banks without the intervention of a private party or buyer and the support of a merger. Some experts and academics have argued that Lehman at the time had sufficient collateral to ask the Fed for short-term funding and avoided the instant collapse that had happened. With the help from the Fed, Lehman might have weathered the financial crisis and be a healthy firm today. But here is some of the impact and consequences of the collapse. With hindsight, we know the decision of the Fed was to not rescue Lehman, causing a calamity of 2008 financial meltdown and the prolonged recession that affected millions of lives in the US and around the world. Policymakers did not fully anticipate the severe damage that the Lehman bankruptcy would inflict on the financial system and economy. In more details, impacts on banks, they were subject to greater government regulations and interbank lending rates rose. Concerning the economy, the cost of borrowing increased and a decrease in retail sales and employment opportunities. The impacts on the global economy, the GDP fell to 4.8%, and banks in Japan, Germany, and England faced huge losses. Because Lehman had ample collateral in short-term loans from the Fed, would clearly have been legal and would have created very little risk for the Fed or taxpayers. So, with the help from the Fed, Lehman might have weathered the financial crisis and be a healthy firm today. Even if Lehman had proved to be inviable in the long run, temporary assistance would have given it time to wind down the business in an orderly way. From the case study, we learned that the myth too big to fail was broken. and always invest in securities which can you hedge risk. Goals and good. Try to achieve them, but without overdoing. Always allocate reserves for risk prevention and management. The events of 2008 will not be the last financial crisis in the US history. Sooner or later, anyone major any other major financial institution will find itself in trouble, and policymakers will have to decide whether to rescue it or not. We can hope that the Fed's officials have learned the lessons of 2008 crisis so that they stand ready to rescue the next Lehman Brothers. Thank you for watching.